All right, welcome back, traders. John Caruso here for the evening of December 7th. It is Wednesday. We're recording this for Thursday's session, December 8th. We're going to take a look at three different charts for you guys here this evening. We're going to look at the December S&P 500, the February gold contract, and lastly, the January crude oil contract. There's been a lot of noise in all three of those markets here lately. So let's take it to the charts. As you can see on the screen here, I do have a weekly chart of the December S&P 500 contract. Clearly, we're staring at a bearish trend. We measure trend 3 to 6 months. Clearly, a bearish trend that we're staring at right now. We've had this longer-term downtrend line that the market's been respecting for the better part of the year. We failed over here in late March, failed once again in late August, and it looks like we're on the brink of another failure right here in the beginning part of December. So I'm going to zoom in to the daily contract for you guys. Zooming in on the daily. Clearly, we've had this upward bias in the market for the past month and a half. We did have the market retesting this downtrend line, which is clearly what happened. Now, I actually did expect, after we saw 3 consecutive days of closing above this downtrend line, I actually did think that we were going to try this upper tract that we have drawn in here, which was going to take us back towards the 71.6 Fibonacci level, or this past peak over here, which was a massive swing high. That did not end up being the case. We actually did kind of have a little bit of a head fake where we closed 3 consecutive days above the 200-day moving average and above this trend line, and the market began to rotate back to the downside. Now, some of the news that came out that helped push markets lower. The first one was the hotter than expected wages data that we saw inside of the November non-farm payrolls report last Friday. And then, of course, earlier this week, we did see the ISM services number that came out hotter than expected as well. You got to remember, ISM services accounts for 2/3 of the economy. So, yeah, it's a big deal. And traders, what they did is they paired the hotter wages, the hotter ISM, and they came to their own hawkish conclusions about the market, and price started rotating back to the downside. Now, what I'm staring at right now, I do have an oversold signal on the S&P 500. I do have a rising low end of my range, which comes in about 39.03. Very key point for this chart comes in at this old swing low at 39.12. So right now we are respecting 39.12. We're trading 39.27 this evening. We're going to see what the market looks like come the morning. But so far we are holding. We've got a lot of support, we think, here with the low end of the range and this old swing low for the possibility of this market potentially rotating back to the upside, retesting this downtrend line, which would come in right around 40.30 this go around. So what would be a potential catalyst for rotation back to the upside? Well, we do of course have the November producer price index number on Friday that the market is waiting with bated breath, I should say, to see what that reading is and whether or not producer prices are still coming in like what we saw in the previous reading. So that could be a potential catalyst that rotates the market back to the upside. Now, if we do take out 39.12, you got to be mindful that there is risk in this market all the way back towards 37.50, maybe 3700, which is this old swing low down here. But I don't think that is the highest probability at the moment. I actually think that we're going to see another rotation. Could be a mini rotation back towards this trend line. We'll see how it does at this second test of it, whether or not we get another failure for a much deeper correction going out into that December FOMC meeting on December 14th, or perhaps we can punch through it and try to test this 71.6 once again. That might be lower odds of that happening. However, I do think that the highest probability right here in the very near term, we'll say over the next week, is that we can get another rotation back to the upside in the S&P 500. So that is a quick look at the DEES S&P 500. I still remain a longer-term bear on equities, but I am recognizing some short-term patterns and some short-term signals that could be telling me that a near-term long-side trade could be in the works here over the next couple of days going into that PPI number. All right, so we're going to switch over to the February crude oil contract. I'm sorry, the February gold contract, not crude oil. All right, so clearly we're going to take this all the way back from the top. clearly bearish trend for the better part of the year. Then we did see that hotter or that better than expected CPI number that came out, and we did retest this downtrend line and eventually punched through it. And the market really hasn't looked back since that happened. This old swing high over here, which came in at about 1738, 1740, that was very important for us because a break above that level, a break and a close above that level, was flipping our trend to bullish trend. So we were bearish trend for the better part of the year. Now we are bullish trend. And we like what this market is doing at the moment. We clearly had this consolidation rotation back to the downside, retested that key 1740 area. We saw that outside day reversal. We put out some buy signals to our clients, and the market has done a pretty good job of following our patterns higher up towards that 1830 level. 1830 was the target because that was the past peaks that we saw over here. We did retest that. We thought it was a high probability that we were not going to break through that area on the first pass. And clearly we did not. We rotated back to the downside. We actually had a pretty good day today, finished up $20 today. However, made another retest and another bid for that 200-day moving average. And as you can see this evening, we're consolidating, moving back down towards 1794. So as you can see how I have it drawn in here, the next move, the next, we'll say 2 to 3% move for gold, we think is going to be back on the downside. So we've got this next correction that comes in, we think could be around the December Fed meeting. If we do get some more hawkish dialogue from Jerome Powell at that meeting, perhaps that could be a catalyst that takes the gold market back to the downside, which comes in. We think the highest estimate of this little mini correction, we'll call it, would be about 1740. Another correction in that swing area. If we were to take that swing area out, we think we could correct as deep as 1690. So I'm going to call this 1740 an accumulation zone. I'm going to call this level 1700 to 1690 a buy zone for the February gold contract. Before perhaps we get another resumption of the upside trend, and perhaps gold has something much bigger to say out into 2023. And we believe that that's the highest probability that we will see higher gold prices out into 2023. There's a number of catalysts that could drive that. Clearly, if the geopolitical climate were to ramp up again, I do think you'll get that safety bid in gold. If perhaps the Fed signals an early end to the interest rate hike cycle that they've been on, I think that's going to be very bullish for gold. But what I'm seeing here is this big inverted head and shoulders that looks to be developing in gold. So I think gold can kind of see the writing on the wall and the fact that the Fed will likely pause at some point out in the first quarter. Inflation is going to likely remain sticky high, we think. And I think all of that scenario and all that picture I think that's painting a very bullish picture and positive picture for gold out into 2023. Now, I'm going to give you a little bit of a disclaimer here as to where all this analysis kind of goes wrong. If we were to break down through, I'm going to say 1680, that would be a warning sign that this analysis is going to be incorrect. It would absolutely be incorrect if we were to break back through this 1620 area or this old triple bottom that formed on the chart. So if we were to break 1680, that would be a warning sign. 1620 is a massive bull market failure. And I think that would prove, I think you'd prove to see a big rotation back on the downside in gold in the first part of next year if we were to break that 1620 area. But all in all, I am bullish on gold. I do think the next down cycle in gold to 1740, maybe 1700 is going to be a buy or accumulation period for gold bulls, and keep that in mind. So that's a look at the February gold contract. Lastly, we're going to take a look at the January crude oil contract. January crude oil obviously been making a lot of noise here lately. This is a weekly look at crude. Clearly, we had this massive bullish trend that developed over the course of 2022 and 2021 and 2022, we should say. Had that little bit of a double top, failed, rotated down, broke this longer term trend line that we had, and it's been nothing but bear market trading ever since. Now I'm going to zoom in on the daily and kind of show you some ideas that we had that we're going to say we're going to say they were half right, because we did get this sideways chop in here. Then we saw that break of that swing lows. You can see when these swing pivot areas, these swing lows, when they break, that is a massive warning to bulls in this market. And that certainly happened back. It was just before Thanksgiving. We saw that breakdown below that 82 area, that old swing low from the range that had developed. And then the next key level was going to be down at that 76 area. And clearly we did test down there, reversed higher, retested back to the downside to 73, hit this mini rising period here over the next 3 to 4 sessions. We actually thought it would extend out into the middle part of December, but the market took a steeper track on this correction up to 83.50, and then once again rotated and failed back on the downside. So I actually did think that we were going to bounce up in here to about 84.50, maybe up to 86.50 before we'd see another bear market failure in there. And that, so we're going to say that we're half right on that analysis. Still thought crude was a sell in here, and clearly rotating back to the downside. Now I'm going to zoom out again and try to give you an idea as to where we think oil prices could be heading over the next few weeks. The next major support area in crude oil comes in down around 65, 66. As you can clearly see that here on the chart. So I do think that any upside attempts and rallies that happen in here, I think they're likely going to fail. I think there's a good chance that we could test that 65 area. A couple things you got to keep an eye on. Clearly, you got to keep an eye on China. I think this market is trading based on the idea of demand destruction, the idea of the rising probability of a global recession, and clearly still on the back of Chinese lockdowns that are taking place over in China. So we did hear some news that China was looking at perhaps easing up some of their restrictions. I believe China was actually supposed to call a press conference. It was either this evening or tomorrow, and give us some more news in terms of what their plans are for their zero COVID policy over there. But clearly, it's risk off in crude oil. Clearly worried about the demand side of the equation and not the supply side of the equation. I do think eventually the supply side story will win out in the end and take prices back to the upside, but clearly don't see that happening here anytime in the very near future. So that's a look at the December S&P, the February gold, and the January crude oil contract. I hopefully that was helpful for you guys. If you have any questions, if you want some more analysis on any of the markets, feel free to reach out at any time. You can email me at jcaruso@rjofutures.com. Best of luck to everybody out there. Have a great night.